Emerald City. It's always best to start at the beginning, and all you do is follow the yellow brick road. Just follow the yellow brick road. Follow the yellow brick road. Follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road. Follow the yellow brick road. Follow the yellow brick road. Follow the yellow brick road. Follow, 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 follow the yellow brick road. Follow the yellow brick, follow the yellow brick, follow the yellow brick road. You're off to see the wizard, the wonderful Wizard of Oz. You'll find he is a wizard, a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does. You're off to see the wizard, the wonderful Wizard of Oz.
We're off to see the wizard, the wonderful Wizard of Oz. We hear he is a whiz of a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does. We're off to see the wizard, the wonderful Wizard of Oz.
That it just broke out to an all-time high of $2,800. And some people are attributing, I've been watching and reading some of the stuff online, watched a few pods, and some people are saying, well, this is just because of the Trump tariffs, and he's probably going to place tariffs on gold produced overseas. I don't think that's it. I think it's, one, I'm not sure he's going to do that. We'll find out. But two, I think it's more likely that just what's going on is there are actually more and more, and this is a chart I saw that was rather compelling. There are more and more people asking for physical delivery of their gold. And why do people do that? Well, because they don't necessarily trust the custodians of the gold, and that's always been the issue with gold. They don't trust the system. And those of us who've been in the gold world for a very long time know that they have created a much larger number of paper claims, in our opinion, than they have underlying ounces of gold. So this is the gold market, very much like the banking market. If people are familiar with banking, they understand fractional reserve lending, which is to say that a bank can lend out more than it has in deposits because not everyone comes and asks for their deposit back at the same time. And that's how the money supply grows. That's the money multiplier. Well, that actually started way back when with goldsmiths in Europe in the Middle Ages. But it's continued to this day where I think there are more paper receipts for gold than there are underlying ounces. The amount of that is up for debate, but it could be anywhere between 10 claims for every 1 ounce, 100 claims for every 1 ounce. So, what I see going on, what we can see in the data is that there are big entities actually asking and saying, well, yeah, that's right. I know you say you're holding gold for me and I've got a paper claim for it. Why don't you send it to me? Why don't you actually give me the gold and I'll store it myself in my safe or my own depository? That started to really increase, which to me indicates that people are starting to say, hey, hang on a second. Maybe I don't trust these people who say they're holding my gold. And I, many of us, even Kaiser before he started in Bitcoin, always thought that that was the Achilles heel of the precious metals market. They'd manipulated it with paper, but if every paper holder said, please give me the physical, there wouldn't be enough physical to go around. And so I think that's what's driving, the breakout in gold right now, not necessarily the threat of Trump tariffs.
I'm speculating, and that's why all the gold in the city of London is being brought back to the United States. But anyway, I read this book over 30 years ago, and I went through this section, but I didn't think much of it. And how did I find out about it? Well, when I met the Gnome of Zurich in November, he told me that J.P. Morgan had been bailed out by Bank of England and the Rothschilds in 1857. And I thought, how do you know that? And he said, well, someone that worked for J.P. Morgan told me about that. And then I went through this book and I found it. So here we go. It's on page 11. It says, then in 1857, it looked as if Morgan would be denied his promised fortune Wheat prices tumbled with the end of the Crimean War. Those wars, Crimean War, Ukraine. I mean, history doesn't repeat exactly, but it rhymes, right? Causing hardship for American banks and railroads. By October, New York banks stopped gold payments. Well, that's what the Bank of England is doing now. Preventing American correspondents from transferring funds to Peabody in London. He was suddenly overextended on his American bills or American investments. At the same time, London investors sold American securities, siphoning more funds from Peabody and provoking a serious cash squeeze. Rumors raced through London that George Peabody and Company was about to fail, a prospect heartily relished by rivals who disliked the old American. And another interesting thing, when you go into the city of London now, right by the Bank of England, there's a Royal Exchange. And outside the Royal Exchange, there's a big statue of a man sitting on a chair. And guess what? That's George Peabody. Anyway, Morgan had also earned the displeasure of Barings by aggressively cutting prices on American securities and trying to steal their accounts. Now the major London houses told Morgan they would bail out the firm, but only if Peabody shut down the bank within a year. When Morgan relayed this patent blackmail to Peabody, the older man reacted like a wounded lion. Defiant, he dared them to bring down the firm. George Peabody and Company was saved by an emergency credit line of £800,000 from the Bank of England, with Barings as a guarantor of the loan. The vengeful Peabody, who felt Barings had mercilessly pressed him to pay outstanding bills, asked that the name of the firm be stricken from a published list of banks rescuing the firm. For Peabody, who had just made a resplendent return to America after a 20-year absence, the incident confirmed his innate pessimism. It is not yet 3 months since I parted from you and left the country prosperous and the people happy, he wrote his niece. Now all this gloom and affliction. So it says the 1857 panic made a deep impression on Morgan's 20-year-old son, Pierpont J.P. Morgan, who had just started on Wall Street as an unsalaried apprentice at Duncan Sherman and Company, New York agent for Peabody. WikiLeaks, and you might think, what are you going on about? Well, as a lot of you know, the gold ownership was banned in 1933 by FDR, Executive Order 6102, and then on January 1st, 1975, it was made legal again. And there was a London wholesale gold dealers' view on U.S. gold sale and private U.S. ownership. So this was like communication between, the U.S. Treasury and the bullion market in London about what to do. Because did you know that the gold contract on COMEX, GC started trading on 31st of December 1974, because the settlement would be on the 1st of December and would be legal. And these people are talking about how they can keep the public in the U.S. Disinterested in acquiring physical gold because, they didn't want them to be too involved. So the U.S. Treasury was in contact with it wasn't called LBMA back then, but it was the bullion market. And this is really interesting, Eric and Clive. This is what it says here. To the dealers, and the dealers are in London, expectations will be the formation of a sizable gold futures market. Each of the dealers expressed the belief that the futures market would be of significant proportion, and physical trading would be minuscule by comparison. Also expressed was the expectation that large volume futures dealing would create a highly volatile market. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term hoarding by U.S. citizens. So you can see that for 50 years, the COMEX and the London bullion market, they've been conspiring to keep U.S. citizens from hoarding gold. And I'm not too much into not prophecies, but like jubilees and things. But it's interesting that this happened exactly 50 years ago, and now we're seeing this scheme seems to be falling apart. About the bullion banks, and he actually said the reason silver has stayed down so much and why the ratio, gold silver ratio, is at 90 is because they manipulate the market. And he said they use the ETFs to borrow the shares in the ETF and take the physical out and lease it out. That's what they do. But in this case, I think what's going on with the GLD and even SLV, because I saw there's a lot of silver for delivery on COMEX this month. What they're doing is they're desperate to find physical because they've been caught short by this 2,000 of actually physical gold that's gone to the U.S. So they're scouring these ETFs for physical. And the other thing you explained in one of your posts, I'm not sure when it was, but maybe last week or so, is that if this move from London to New York was just about arbitrage, they would have done it through the paper market. Why ship 2,000 tons just to make like a dollar per ounce? Yeah, it doesn't make sense, right?
Well, they are putting it on planes every day,
Yeah.
according to Esther and George Fair, who is the CEO of Scottsdale Mint. They are putting every single plane. This is exactly what he said. Every single plane that goes from London to New York right now has gold on it. Every single one of them, nonstop, every day. 2 tons here, 2 tons there, every day. That's how crazy it is. Why would they go through all that trouble if all that gold is going to flow back to London, or it exit the US to somewhere else? It doesn't make any sense. And I understand where the other experts are coming from. They're saying that, okay, this gold comes into the US. They're saying it's not the US government, it's not US government proxies buying it. It's just regular guys like me and you, hedge fund. Nobody with any connections, buying 2,000 tons of gold in 2.5 months without any objections from COMEX. Okay. Or any U.S. government agencies. Let's say that I believe them for a second. Why would they, like I said on some of my posts, if these guys are regular investors, why would they go through the COMEX to buy all this physical gold such that it breaks the LBMA and also breaks the banksters, the bullion banks, their EFP trading pairs? Because remember what I said on the show last time, the EFP trading pairs used to have a positive EFP spread. Now it's negative.
And what it will take for silver to finally thrive. As you may know, silver has repeatedly tried to break above the $32 to $33 per ounce range over the past year, only to be aggressively slammed back down each time. I don't believe this price action is random, organic, or coincidental. On the contrary, I believe it is clear manipulation by bullion banks like JP Morgan and UBS, which are determined to suppress the price of silver on behalf of central banks like the U.S. Federal Reserve in order to maintain confidence in paper currencies like the dollar. In the next few slides, I'll zoom in on the intraday time frame to give you a closer look at how these slams unfold. Here, you're looking at the 5-minute intraday chart of COMEX silver futures from Friday, February 14th, 2025. Early that morning, during the Asian and European trading sessions, silver surged by approximately $1 per ounce or 3%, reaching a high of $34.24 per ounce. Silver appeared ready to finally break through the $33 resistance level that had been held since May 2024, sparking excitement among investors. Then, around 9 a.m. New York time, once the U.S. trading session had begun, a massive flood of paper silver in the form of futures contracts was dumped onto the market, deliberately driving the price back below the critical $33 level. Please note that the silver being dumped was paper silver, entirely unbacked by actual physical metal. This is how bullion banks artificially suppress the price of silver, keeping it well below where it should be based on the true supply and demand for physical silver. What's sad and infuriating is the fact that this pattern of manipulation has persisted almost daily for decades, consistently driving prices downward, never upward.
It speaks more to me of a default than anything else. And we've talked at length about the massive amount of naked shorting in London, which amounts to 90% of all the trades are paper. And a lot of people say, no, none of that stuff is, it's taking advantage of arbitrage. It's bringing gold home because there are people afraid of war in Europe. It's the Trump tariffs. It's traders on COMEX are no longer rolling over their contracts. Many of them aren't. And that's really the difference. That's what enables this rehypothecated system to continue, because we don't stand for delivery. So we just keep rolling it over. It's a cash settlement. It's a speculation, or it's a hedge. But standing for delivery was something that never happened. And we started talking about this in 2020. I guess I'd rather be 5 years early than, 5 seconds late. And we were talking about how there was a slow bleed down of inventory and deliveries happening at an accelerated pace, which was really unusual at that point, like an outlier. Well, not so much anymore. In fact, contracts standing for delivery have led to an open interest surge of over 750%. Open interest being those that are standing for delivery. I guess to me, this raises the question, why are the traders in the nation states and the central banks suddenly standing for delivery? That should be something people are asking themselves. The folks that are standing for delivery are not something to be dismissed. These are very sophisticated traders. And at the same time, another strange occurrence is that the net long position on COMEX is rising rapidly, while the short position is at its lowest since 2020. So being naked short right now when everyone is standing for delivery is akin to a mud wall in a rainstorm. Stupid, to say the least. We talked a lot about the contracts that stood for delivery last month. 15,691 contracts stood for delivery, 78.5 million ounces, second highest in COMEX history. Another 4.6 million ounces of silver was taken for delivery.
Physical ratio market is breaking. And, when you realize HSBC, Scotiabank, JP Morgan, they depend on these derivatives and these unallocated gold to hedge their positions. They're not going to be able to take these massive naked positions anymore, these positions that have allowed them unabated to manipulate the market, because as I've surmised for a long time, there are entities starting with the BRICS and now the United States that are getting wise, I think, to just how important physical is in a game that's rigged.
How do I start for Emerald City? It's always best to start at the beginning, and all you do is follow the yellow brick road. Just follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road. Follow the yellow
the yellow brick road. Follow the yellow brick road. Follow the yellow brick road. Follow, 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 follow the yellow brick road. Follow the yellow brick, follow the yellow brick, follow the yellow brick road. You're off to see the wizard, the wonderful Wizard of Oz. You'll find he is a wizard, a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does.
A bank has two primary functions. One is the demand deposit. So you go and you put your gold and silver in a bank and you get notes off of it. And at any time, you can come back and you can reclaim your gold and silver. That's called a demand deposit. It's a checking account, right? The other service that a bank provides is what's called the time deposit. So that is where they find a lender and they find a borrower and they match them together and they say, we will give you yields. Now you have to pay for demand deposit. Nobody is going to sit there and offer you money to vault your gold for you and just look at it, right? So you have to, if you want somebody to protect your gold and have armed security and the big vault and the alarm system and the insurance, all that stuff costs. So you have to pay for demand deposit. Now, many people, especially if you have large deposits, they balk at the cost of that. And they say, well, why don't I loan some of it out in a time deposit? So the banker acts as a middleman. So he finds somebody who wants to borrow money and he connects them to you, and you get a percent of yields on your loan, and the bank gets a small cut of the yields as well. Now, the problem with time deposits is sometimes the banker messes up, right? He loans out your money to someone who can't pay you back, right? The business didn't work out, whatever. So the banker's sitting there tossing and turning at night. He says, oh my God, I've loaned out this bad loan and they can't pay me back and the time deposit's coming due. What do I do? What do I do? And so he looks at the giant pile of gold sitting in the demand deposits and he says, you know what? They're not all going to come back for this gold at the same time. So I will just take some gold out of the demand deposits, use it to pay off the time deposit, and I'll figure it out later, right? The trouble is once you've done that, you've created Schrodinger's dollar, because you have a dollar sitting in the demand deposit and you have you have that same dollar that was used to pay off the bad loan. And there's only half the gold underlying that, right? The gold can only satisfy one of those $2. So you have guaranteed at some point, someone somewhere is going to have a bank run because there's no longer enough gold to satisfy all the notes for gold. You can think of the $42.22 note coupon as an offer for gold on an indefinite time horizon, or even an infinite time horizon. So at the end of time itself, when the last stars have twinkled out and only black holes exist, you should be able to go down to the door of the Eccles building and knock on it and say, I would like to, can I redeem my note now, right? Can I redeem it for $42.22 an ounce now? But if you want it today, if you want gold today, you have to pay, that's like a futures contract. So if you want it today, you have to pay much more money. You have to, much more dollars. You have to pay $2,950, right? So you could think of it almost like a rubber band. So here is the $42 is the base, and then the present keeps going farther and farther and farther and farther and farther away from it. And eventually it's going to snap, right? Because this is going to lose all relation to this and the rubber band snaps. Now, what the revaluation, what they're talking about, what the people who do not understand money saying is, if we revalue this to $3,000, it'll just go bloop, and then there will be no more stress on the banking system. There will be no more stress on the monetary system anymore at all, right? We're just going to go boop. It's just a technical. It's just a balance sheet issue. It's a gimmick. Doesn't mean anything, but it'll help. It'll help the Treasury Department, pay some bills. If you were to revalue this to this, what would happen is it would just shift over. So we'd have the statutory price goes from $42 to $3,000, but then you can think of it as, so I could have an ounce of gold for $42.22 on an infinite time horizon at the end of time, or I can have it right now for $3,000. So if I bring that to the present day, now I can say, well, I can have at the end of time itself, I can have $3,000. I can have gold for $3,000 an ounce, or I can have gold for $3,000 an ounce right now. So what are you going to do? People say, well, I'm not going to live till the end of time, so I'm going to take $3,000 right now. So everyone rushes out to buy gold, and that skyrockets the spot price of gold. So once again, back to the rubber band, it just shifts over. And so now the statutory price is $3,000. And the market price is $15,000, $20,000, $30,000 an ounce. And this will happen, within a couple of days as well. The definition of an investment is a vehicle to get more money. That's what it is. That's why people invest. That's why you loan out your money to bonds and stocks, is because you want more of it later on in the future. Gold is money. So investments are vehicles to get more gold fundamentally. Now there is the dollar in between those two things that is sort of muddying the waters. But at the end of the day, gold and silver are money itself. They're not vehicles to get more money. They are in fact money. Now, the way it feels like an investment is because their purchasing power in dollar terms is going up faster, especially now, going up faster than investment vehicles are able to generate more dollars to be able to get more gold. So you're better off buying the gold and silver right now than you are trying to invest to get more dollars to get more gold and silver later.
The appeal of an asset that exists outside the credit system becomes impossible to ignore. Here's the thing about modern finance. Almost all wealth is trapped inside the credit system. Stocks, bonds, real estate, even your bank deposits. They're all just IOUs, dependent on someone else keeping their promises. Gold doesn't play by those rules. It doesn't need a government. It doesn't need a central bank or a financial institution to back it up. It simply is. And that's becoming a bigger deal as the global credit system starts to crack. Governments are drowning in debt, with debt to GDP ratios over 100% in many developed countries. But in the last few months, it's like the real life gold market has become the center of the action, with all the intrigue of a blockbuster thriller. We've seen gold prices skyrocket past $3,000 an ounce, a massive exodus of physical gold from London to New York, and just this past week, COMEX quietly cancelling a slew of contracts. It's like they're deleting embarrassing social media posts, hoping nobody notices. But we noticed. The question is, are these just routine market adjustments, or are the powers that be preparing for something far more significant, something they don't want us talking about? Does it mean the London vaults have been cleaned out? Let's start with the official narrative. COMEX, the primary exchange for futures and options on metals, announced they're delisting several contracts tied to London gold. These include gold kilo futures, London spot gold futures, London silver spot futures, and cleared OTC London gold forwards. Their explanation? Essentially, there is no open interest in the contracts. Translation? Nobody was officially trading them. When GATA pushed them more, they were told by a CME Group spokeswoman that the lack of activity in the products led to the decision. COMEX, like any exchange, periodically reviews and removes contracts. Low trading volumes, limited participation, redundant alternatives, or regulatory changes are typical reasons. Delisting simply means these contracts won't be traded or cleared through COMEX anymore.
Gold. Where do you want to start with gold? How about just that London is in default? Is that a good starting point?
Yes, sir. Let me just show you this. A tweet from our buddy Chris Marcus at Arcadia Economics. Shocking comments from the Trump admin, especially if you're a gold and silver investor or a bull. Eric Young retweeted that saying the U.S. government's attempts to repatriate physical gold, audit U.S. physical gold at Fort Knox and maybe at the New York Fed, etc. Monetize U.S. physical gold for UST physical gold bonds. Listen to Scott Bessent. Ladies and gentlemen, there's a sea change happening in this country and overseas. The LBMA is on fire. Go ahead, Jim.
We got a London default in gold and silver. We've got a pushback. Instead of an actual default, what they're doing is they're wrecking the forward months. That'll be June. They're wrecking June. They're beginning to wreck September. Those are delivery months. A very interesting unintended consequence to many people, but I believe it could be part of a very clever, sinister plan for Trump. Sinister, Sean, in a good sense. It could be that the tariffs, part of the motive for tariffs, okay, in addition to encouraging foreign direct investment and conversion of treasury bonds in the United States, in addition to reindustrialization. It could be that a secondary motive for the tariffs was to vacate London's gold and bring it to the United States and force a default in London and wreck the Satanists there. It is happening. There is no better indication right now than something that is called the implicit lease rate. And I don't have the exact formula. I remember seeing it years ago, but it's something like, a certain rate and you subtract another thing. And what you get is the implied leasing rate for gold and silver. And those are usually around 1/10 or 2/10 of 1%. And it was about 3 weeks ago, silver went over 5 and 6%. And I think gold is up towards 7%. What we have now is a scramble because of something that is about to become revealed by Trump. And I don't know how he's going to do it. I have some guesses. Pardon my moving around, I'm just a very fidgety guy. I think we're going to see Trump reveal how we have multiple parties leasing the same bar of gold. Shanghai doesn't permit that. If you have a lease, then you've got a lease with a serial number. In the United States, if you got a lease, then you got a lease against an allocated vault. And you don't know which bar. There are rumors, and some of my smartest colleagues are saying, Jim, you don't realize individual gold bars have been leased out 10, 12, 15 times over.
All coming together now, and is going to destroy the central product, the product of the central bank, the Federal Reserve, which is the Federal Reserve note. Once it comes out that there's at least 100 times more dollars in circulation, and that 99% of those dollars that are in circulation are created without any back end on the Treasury books, without any back end on the Federal Reserve, so they don't show up on official books anywhere. Once this becomes acknowledged, then the dollar is toast. It's gone. It may come out that this is more like 1,000 times or worse. Maybe it's 1,000 times more dollars are in circulation than are officially supposed to even exist. But once that comes out, the dollar it's totally gone. Ahead of that, you will see smart money trying to get the fuck out of banks, trying to get the fuck out of dollars as fast as they can. And this is going to cause a weird kind of an effect, okay? Because while the real estate market is crashing, the reaction are coming because people don't understand why the system is doing this, why it's collapsing, because nobody admits that it's a controlled implosion created by the people that created the fake system to begin with, which is the Jews. And it all goes back to Israel, AIPAC, the assassinations, et cetera, et cetera, et cetera. Anyway, so as this comes out that the money is terrible, slightly ahead of the big impacts, you'll see money start flooding into anything that's real, okay? So anything that has actual scarcity. Anyway, so in my opinion, we'll see the flood go into and suck up as much silver and gold as is available. And there's going to be shockingly little of that. It's awful hard to put hundreds of millions of dollars into gold, okay? Any movement this way is going to drive the price of gold up, way up. We're going to break the bounds, in my opinion, this summer, probably before official summer, but sometime after the 1st of May. Actually, it shows up more towards the end of May, but after the 1st of May, we'll start seeing inflows going into cryptos, gold and silver, and to some real estate, okay? So there will be some real estate, even some commercial real estate, that will be worth having. Some of these will include like hotels, but not office buildings for people to go in and work, because it might be 10 years before they'd be able to get those office buildings rented out enough to make any kind of a serious cash flow from them. But we'll see a lot of money go into gold. The price of gold will go up. We'll see lots of money try and go into silver, and silver will become unobtainium. You just won't be able to find this shit.
So gold revaluation, really dollar devaluation in the Bitcoin Act, a bill.
I'm just a bill. Yes, I'm only a bill.
To establish a strategic Bitcoin reserve and other programs to ensure the transparent management of Bitcoin holdings of the federal government. You'll see that the Bitcoin aspect of the Bitcoin bill is completely irrelevant to the dollar at all, and I'll explain why. This act may be cited as the Boosting Innovation, Technology, and Competitiveness Through Optimized Investment Nationwide Act of 2024, or the Bitcoin Act of 2024. Section 12, or whatever that 12 means, says Federal Reserve System gold certificates not later than 180 days after the date of enactment of this act, the Federal Reserve Bank shall tender all outstanding gold certificates in their custody to the Secretary. Not later than 90 days after the tender of the last such certificate, the Secretary shall issue new gold certificates to the Federal Reserve Banks that reflect the fair market value price of the gold held against such certificates by the Treasury, as of the date specified by the Secretary on each new gold certificate. Upon issue by the Secretary, each Federal Reserve Bank that receives a new gold certificate shall remit the difference in cash value between the old and new gold certificates to the Secretary for deposit in the general fund within 90 days. What this means is that the Fed will print about $800 billion and hand it to the Treasury as the revaluation of its gold certificate account takes place. But really, it's not the gold that is being revalued. It's the dollar. This is a possible timeline that I found on Twitter or X. It's plausible. We'll see. I don't know if anyone understands in the Trump administration what gold is and what the dollar really is. If you believe this is just an accounting gimmick, that it doesn't matter if gold is $42.22 on a balance sheet or $3,000, what's the difference? It's all just a gimmick to print $800 billion so they can spend it on Bitcoin. Ask yourself this question. If gold is not money, if the real price matrix is not gold ounces but rather dollars, then why does the Fed maintain an absurdly obvious fiction on its balance sheet? Here is your hunk of dollars. Enjoy your Bitcoin. Enjoy cracking up the foundations of your entire monetary system in order to add another layer on top so you can see above the clouds. The answer is because gold is the price matrix, because everything is priced in ounces of gold through a derivative called a dollar. Now, people have asked me, what if they don't buy Bitcoin with these dollars? My answer is it doesn't matter what they buy. They don't even have to buy anything. It's not a question of the money supply adding 800 billion units to it. That doesn't really matter that much. The money supply is already like 23, 24 trillion or whatever it is. Another 800 billion is not going to cause prices to triple, quadruple, quintuple in a few weeks. The issue is the revaluation of gold itself. Once the fiction of 42.22 is admitted as a fiction officially, the entire price matrix is going to change very quickly. All of the purchasing power for all of the capital on the planet is going to be sucked out of dollars, and all of its derivatives, which includes every other currency on the planet, because the dollar is the reserve currency of the world, and all of that purchasing power will be vacuumed into gold. Silver will move up pro rata with gold. Silver flows, they are relentless, they are continuing. Silver holders, you're safe. If there's a gold revaluation, silver will also be affected even more so. And so I hope this bill passes.
How do I start for Emerald City? It's always best to start at the beginning, and all you do is follow the yellow brick road. Just follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road. Follow the yellow brick road.
Follow the yellow brick road. Follow the yellow brick road. Follow, 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 follow the yellow brick road. there was, the Wizard of Oz is one because of the wonderful things he does. You're off to see the wizard, the wonderful Wizard of Oz.
We're off to see the wizard, the wonderful Wizard of Oz. We hear he is a whiz of a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does. We're off to see the wizard, the wonderful Wizard of Oz. We're off to see the wizard, the wonderful Wizard of Oz. Here he is, a whiz of a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does. We're off to see the wizard, the wonderful Wizard of Oz. Oh, we're off to see the wizard, the wonderful Wizard of Oz. Here he is, a whiz of a whiz, if ever a whiz there was. If ever a whiz there was, the Wizard of Oz is one because of the wonderful things he does.